On July 9, 2026, the Federal Reserve faced a new variable in its inflation modeling. New York Fed President John Williams warned that massive investments in artificial intelligence infrastructure, particularly data center power, materials, and specialized labor, represent a real inflationary threat. Williams suggested that if this demand-side pressure remains high, the Fed might have to raise interest rates or keep them elevated longer than expected to cool the economy.
This inflation concern matches Wall Street projections. Goldman Sachs released a forecast indicating that the Fed will likely keep interest rates unchanged for the rest of 2026. Goldman economists argue that sticky core inflation, currently tracking at 3.4%, will prevent the central bank from cutting rates this year, keeping pressure on technology valuations.
Semiconductor manufacturers are rapidly expanding capacity to meet this AI demand. Micron Technology announced that it has increased its long-term investment target to $250 billion by 2035. The funds will build out domestic memory manufacturing, including a new fabrication plant in Clay, New York, which Micron reports is running ahead of its construction schedule. At the same time, international chip makers are seeking direct access to U.S. capital markets. South Korea's SK Hynix, a primary supplier of high-bandwidth memory, has priced its new Nasdaq American Depository Receipt listing at $149 per share. The listing, scheduled for July 10th, aims to raise over $26 billion to fund packaging facilities and lithography equipment. While corporate investment expands, equity index markets show signs of technical vulnerability. The Nasdaq 100 is trading close to a massive options put wall on the QQQ exchange-traded fund at the $700 level. Market data indicates over $100 million in open interest concentrated at this strike, which is a critical support floor. This options concentration introduces hedging risks. Below the 700 level, the market enters a negative gamma regime. In the state, market makers must sell index futures as the price drops to hedge their positions. This mechanical hedging can accelerate selling pressure and trigger a waterfall decline if the support level is breached. Deteriorating market internals compound these technical risks. Less than 45% of technology stocks in the Nasdaq are currently trading above their 50-day moving average. This low breadth shows that a few mega-cap names are holding up the index, while the majority of technology companies are already in downtrends. The concentration in megacaps is forcing active fund managers to change their strategies. Terry Smith, the manager of the large Fundsmith Equity Fund, announced that he is abandoning his traditional buy and hold approach. Smith is increasing portfolio turnover to include momentum factors, arguing that passive index flows are setting prices rather than business fundamentals. This change shows the pressure on active managers. Only 28% of investment managers are outperforming the market in 2026. This widespread underperformance occurs as market momentum reaches its highest level in 30 years, surpassing the levels seen in late 1999 before the dot-com crash. While financial markets chase momentum, the real economy shows signs of stress. Pepsi CEO Ramon Laguarta warned that the American consumer is in worse shape than expected. Laguarta noted that lower-income households are facing budget pressures, leading to volume declines in staple consumer goods. Pepsi's own business reflects this slowdown, with its North American beverage volumes dropping 4% in the second quarter. This decline matches Federal Reserve data for May, which showed revolving credit balances fell by over $5 billion. The contraction suggests that consumers are hitting credit limits as savings shrink. Other economic indicators show this slowdown. Existing home sales fell 2.4% in June to an annualized rate of 4.09 million units, missing Wall Street forecasts. In retail, companies like Lowe's are reducing product sizes to offer cheaper options for cash-strapped shoppers. The source of these economic challenges is structural pressure in the labor market. The U.S. labor force participation rate has fallen to levels not seen since 1976. This decline in active workers helps explain why 49% of American adults under 30 are currently living with at least one parent, showing long-term household budget stress.